with Silicon Valley and the way that they operate. But I'll put a bookmark in that not to hug the mic.
Can I step in just for a quick second on that? Because one of the things that, just to follow on what Daniel was just saying, so the DCCPA, which is the Digital Commodities Consumer Protection Act that was proposed, that would have given a lot of power and control, but to the CFTC. But I think what we're hearing is that that act, that bill was kind of close to FTX in some ways. And so it's not clear what's going to happen with that, or chances are strong to be passed. So it's just something worth noting that even the penumbra of the FTX, cascading effect of that's even affecting the legislation.
Yeah, I mean, if you have any hope that Congress is going to do anything, even after the debacle that the majority couldn't even elect a Speaker of the House, and you should tell me what the lottery numbers are, because I think you know more than the rest of us in that case.
Julia, any comments on that?
Yes, my firm builds technology, and I've been in fintech as a CTO and as a technologist. But now that I'm on the board of directors of the bank, a lot of the conversations that happen around the table is about acquiring technology. And I have to tell you that from the financial services firm's perspective, they welcome regulation at this point, because they're in a really tough spot. And so there are banks that are going through like the basic digital transformation. They're just trying to get out of mainframe systems and, function at a level that allows them to actually scale up. And once they get to that point, they start looking at a variety of fintechs that are providing amazing services. And honestly, what they're seeing is that these fintechs are being regulated through the banks, essentially. So it puts the banks themselves into a very difficult position. So they want to offer digital assets, let's say, you know what I mean? They want their clients to purchase crypto, and they want them to use companies like Upstart and a variety of payment solutions. But it's very, very difficult because you don't know what the regulator is going to say, because they're like quasi-regulated through the banks themselves.
Mm-hmm.
Yeah,
go ahead.
It limits, I think it limits the ability to acquire clients, to fundraise. Do you see what I mean? It's like it's affecting a lot of processes that need to move, right? For all of these companies for all of the fintechs to finally get the clients, get the funding, sign all of these deals. So it's in a holding pattern in a way.
So Robert, let's talk a little bit about the valuations right now of all the fintechs and what's going on. I think that the valuations right now are down. There's a down round for a lot of the companies. A lot of the fintech actually have a mess of getting a clawback, issues of being funded by FTX. Any good investment? Any hope for like fintech right now? What areas do you think are safe, and then what's the opportunity in there?
Sure. So the market is highly segmented, and it's grown so quickly to over $194 billion market cap in 2022 last year, but it should grow more rapidly at about a 20% compound annual growth rate to about close to 300 billion by 2027. So we're going to have the market grow by another 150 billion in the next 3-4 years. The top growth areas are going to be embedded finance, which integrates payments and loans, debit cards, insurance into non-financial platforms. So for example, Uber, you pay a tip on Uber, or when you buy Uber Eats, you can give them a tip. So that's an example of an embedded application, but that's going to now integrate payment applications across a whole range of non-financial platforms. So every company will have a fintech component. That's a huge growth area. So that's embedded finance. The other big growth area is B2B fintech. The third biggest category of fintech is emerging markets, the underserved, bottom 2 billion, out of 8 billion people who are not connected to any bank but need financial services. Then the CFO stack, which is really infrastructure as a service, backend as a service in the cloud with anti-fraud infrastructure, payments, compliance, taxes, buy now, pay later. All these modules will be integrated into, from the cloud into a CFO portfolio. So that's another big area of fintech. Gamers, that's already a very fast growing area. 3 billion people out of 8 billion on the planet are gamers, spending 159 billion a year. And many of them are mining tokens or trading digital assets and engaging in blockchain video games. So that's another growth area for fintech. So I think the valuations, of course, have come down because the market has collapsed for technology overall, but banks are rapid adopters of fintech startups to stay relevant. So Citibank, Barclays, UBS, Morgan Stanley are leaders in digital transformation by outsourcing to startups. So this whole area has many segments that are growing rapidly. And DeFi is another area, $180 billion total value locked, mostly on Ethereum, but many other cross chains. So you're going to see a lot of on-chain banking embedded apps with DeFi in the cloud. And again, remember that FTX was a centralized exchange, Uniswap decentralized. So you're going to see a migration to more decentralized exchanges, which have much less risk and excellent decentralized financial controls and smart contracts.
Mm-hmm. Well, thank you very much for that update. And then I'd like to turn over to Jacqueline. Jacqueline, what is the current advice from your standpoint of view of building up this legal cloud around potential clients and investments for the family offices? Like, what kind of deals are you looking for, and then what's the red flags that you can identify in the fintech area not to invest in?
That's great, thanks. I think one of the themes that we're seeing in terms of, well, first of all, there's just a chill on deals, just the cascading effect of the current status of sort of the FTX, the sort of leverage and lending that came down from there has put a chill on deals altogether. And so we're not seeing a lot of current action on that. We're seeing a lot of fallout on the sort of bankruptcy and insolvency side. And I think I noticed today that in the FTX bankruptcy petition, there are 5 family offices clearly named as creditors there, so, well-known family offices. So that's just one thing to keep in mind, that there is going to be a focus on operational due diligence and on the sort of who do you rely on to do the due diligence when you're looking at these transactions. The last panel was which I got to hear the end of was fantastic, and they spoke a lot about sort of the club deals and the professionalization of family offices and getting into those kinds of transactions. We're seeing a lot of that. Family offices often are trying to back up onto a pool of diligence that others in the team have done. And so I think you're going to see family offices being more careful about how they're going to be relying on that due diligence going forward. In terms of other ways of ensuring sort of safety and deals, I think you're also going to see family offices seeking to diversify, maybe going into more funds of funds as opposed to, or funds to invest in crypto rather than direct investments. That's something that we've seen as well.
Well, thanks so much. And Julia, you shared earlier today with me something that was interesting. It was merging the metaverse and the fintech and the trends that you wanted to talk about it. Can I brief us? Yeah.
Yeah. So as you know, one of the big areas for fintech with the larger financial services firms is conversational AI, and the fact that, let's say, core AI powers the Citibank chat, they also do this for Pfizer, etc. But there are a lot of large banks that use these bots, right, for conversations. And now what we're seeing is there's a desire to put a human form on that. It's called Digital Humans. I don't know if you've heard this term or not, but if you go to digitalhumans.com, and I'm going to drop a link into this chat, there is a digital human representation of Daniel Kalt. He is the chief economist of UBS in Switzerland. And Daniel is available to speak with UBS clients in the wealth division and essentially provide the macroeconomic updates and actually have conversations with the clients. So there's definitely a desire to clone themselves. I think Marty should try that next. Yeah. But we're moving in that direction, right? There's all this tech and not enough customer interaction, and I think that this is going to be big.
Yeah, actually, before the conference, I tried to do like tried the chat GTP and kind of give me a rundown of the future of the fintech for 2023. And then but it was pretty, it was this decent article that it generated, just so you know, like, yeah, it was grammatically correct, but at the same time it was kind of like watered down. It said, but it was smart enough of saying, hey, I'm basing all that my essay or whatever, the report, on the 2022 numbers, and then 2023 I don't have enough data to make intelligent assessment. So it's pretty good, right?
Well, obviously it's hard to clone the chief economist, but if it's a bot and it's kind of a teller or customer service, right, with this type of face, that's like that looks pretty good though. It could be more fun for people as opposed to just typing, right? So for simple inquiries like what's your account balance, etc., we might start seeing digital humans. So I think it's just beginning to develop, Arthur.
Yep. Hey, Daniel, you're the gaming guy here. Any money to be made in the gaming payments? Is it still like a viable platform, or is that the only one that kind of escaped the current issues? What's going on there? Can you tell us a little bit about it?
What a segue! What a question, Arthur.
Well, just trying to pull the best out of you.
Thank you. Yeah, I mean, so like I actually do want to comment on the previous topics here. I don't know about the rest of you. Yeah, I don't know about the rest of you, but as far as like digital humans go, I'm the guy that always press 0 on the operator before going through the whole phone menu, because I still need a person at the end of the day. If you've ever had to deal with Uber, for example, and there's a cancel ride and they want you want to get their money back, it's very easy to get $5 out of them because it's programmed to say if there's an issue, give $5. But I always feel like I prefer a person. So I think that technology is a little far off. As far as what you asked about, the collision of gaming and fintech, et cetera. Listen, I'm, as Robert alluded to, gaming as an industry is bigger than Hollywood and music combined, right? And it's a stat that we always talk about, but we don't really figure out where the money is, right? And so someone like Epic, which is a game developer, which, if you've got children or friends that play video games, makes a very popular title called Fortnite. Fortnite's a free-to-play game, and they make over $1 billion a year selling digital assets. And what do digital assets mean? They literally mean different outfits for your characters to wear in the games, right? And you don't get anything out of that other than improving your game experience. And so I think people have seen this signal and this trend, and just like any industry tends to do, when there's one successful player in it that's done this really well, they all try to replicate it and say, well, we're gonna upsell people in the game regardless of whether there's actually a quality game there, right? You think of, or you hear about things like play to earn, and wanting to be able to transfer digital assets across different gaming ecosystems. So listen, I would say generally, as far as a trend where the money is being able to facilitate. Well, first of all, you need a good game in general, right? I think that's important. But being able to upsell players in games to do different things, whether that's to buy skins, that's to buy things like loot boxes, which are basically like, ripping packs of trading cards or NFTs, et cetera. which a lot of people, or NBA Top Shot, which a lot of people are doing. So yeah, sure, there's a lot of opportunity. I teach a class about esports, which is the very small subset of gaming, which is about how do we turn video games into a spectator sport. And everyone has been betting on the eyeballs, but they don't really know how to monetize the eyeballs. The game developers understand how to do it. But there's a lot of room for people that are in the picks and axes business, so to speak, to be able to create infrastructure around these things to figure out ways to monetize. Because unless you're a game developer or publisher, everyone else is sort of in a parasitic position, so to speak. So you gave me a broad question. I gave you a broad answer. Happy to dig in wherever.
Yeah, I'll have to relabel you like Chat GPT.
Well, I think for you,
water.
having known you for a while, Chat GPT could be a really good tool for you because you don't set the bar very high for grammar. So that would be a money use case for you.
There you go. Well, thank you.
Arthur, I have a quick example to what Daniel said. So when Squid Games ran on Netflix, at some point in Roblox, there were 700 million people who played the Squid Games instance of Roblox. And very short thereafter, Netflix basically said they're going to roll out Netflix gaming. So I think that 700 million people playing the game, that's why obviously people want to monetize content through that.
Well, that was in the works for a while, Netflix gaming. But I think you raise a good point about people want these immersive experiences, which is why we talk about the metaverse a lot.
Yeah.
So I have a buddy who would be a good person to talk to, who's still in his mid-20s, but when he was in high school, like 16, 17, was making like $40K a month building custom Minecraft servers where they took Minecraft and they created a Grand Theft Auto version of Minecraft.
Mm-hmm.
So being able to create these communities around existing IP is also another place where money is made. But again, we could talk about it later. Arthur, I'll kick it back to you.
Sorry.
No, that's okay. Well, thank you. I'm Polish, so I'm allowed, okay? And Polish Jewish, so I'm allowed to break the rules of the grammar. I came off the boat, right? First generation, so it's all good. Hey, let's go get a crystal ball again, and we didn't get any Chat GTP good assessment of the future. So Robert, tell me, what do you think? Are we going to sustain the growth of the fintech over the 2022 to 2023? In your assessment, is there the path of growth? Like, do we have substantial numbers to justify that?
So, as I said earlier, the market for global fintech is over 190 billion in last year, and it'll grow by 20% a year for the next few years. So, but the most of the growth will be in the developing world, the Indonesias of the world, Brazil, America Mobile is the largest carrier in Latin America. There's over 190 carriers, of which 2/3 of the people on the planet use over 100 carriers. So the mobile infrastructure, blockchain infrastructure, fintech infrastructure is overlapping. At CES and at World Mobile Congress in Barcelona, you see a lot of exhibits on fintech integration into mobile services, primarily small, medium-sized business. So I think you're going to see rapid growth in spite of this, growth recession in fintech. And it's while the valuations have come down, the liquidity, the M&A has come down dramatically. That's just another big opportunity for startups to engage and be lean startups for a year or two until the big money comes back. But big banks are still spending hundreds of millions a year each over a period of the last 2 years. So we're going to see continued activity by banks integrating fintech.
So we're still cool, right? We're still.
Oh no, it's not. The industry is going to grow rapidly. It's not going away. It's just had like I said, it's a dip thanks to high interest rates.
Can I add a question to what Robert just said? And that is, I think that what we're going to also see and what we're talking about at the law firm a little bit is where crypto was, the promise of crypto was you didn't need intermediaries, you didn't need sort of anybody to intermediate. What we're seeing in the development in the place where a blockchain is really being powerful is where you have institutions using that blockchain. So you have those intermediaries coming back in, but maybe we're reducing cost margins a little bit. And so I think that is a place that we are seeing some development and still some deal flow.
Actually, I have a follow-up question to you, Jacqueline. So the blockchain is something that protects the data structure, right? And then we have a number of different laws, including the California law, that allows or that disallow for the editing of the blockchain. And so there's different states that are actually coming in with their own set of rules and regulations. So how is that process working out nowadays?
So it's a really interesting question, and it's not my specific area, but I have heard, we have been talking internally about some cases where different states are coming in and asking for data behind blockchain and behind, certain ledgers that are being included in some of these crypto businesses. And they ask for that data for various reasons, and they come at it through securities rules, et cetera. So until you get to the point of saying that cryptocurrencies are securities, they're not really supposed to be asking for this kind of information. But we have had challenges by various states, and we're contesting that because the states themselves cannot keep that information safe, right? So part of the worry is that once you have to start disclosing that information, in whatever state it is, you're going to have breaches and you're going to have vulnerabilities to bad actors in the blockchain. So I'm agreeing with you. I think there is some real uncertainty about it. And I think it's definitely moving in the right direction, I think, but I'm not sure that we're not going to see more chaos before we see more unity.
You have about 20 minutes.
Okay, perfect. So
I got a question.
yeah, go for it.
Hey, I got a question for Julia and a question for Robert. So my first question for Julia is that right now banks and like hedge funds and et cetera are laying off like crazy. And the experience is that whenever that happens, they lay off people from their non-profitable areas, and then they try to replace them with white label solutions. That's a great opportunity for fintech, right?
Yes, and there are incubators that every single, Barclays has the Barclays Rise incubator where they track everything. JP Morgan just created this open DeFi platform where they're hoping that everybody's just going to come in and plug into their DeFi environment. I'll find the name for it, Marty, and I'll send it to you later. So there's the opportunities for fintechs to engage with, all of these institutions is endless. That's not been going away. I think that the hiring and the firing cycles have more to do with the stock share price, than anything else. So they're playing with the numbers always, in the downturn.
Yeah, you guys know we had Tim Draper in Miami, and he said that the decentralization movement is a $10 trillion marketplace. So I don't disagree with that. Because from an engineering point of view, I think there's a lot of engineers in the audience and some AI guys. I mean, whenever you engineer stuff, you daisy chain it. You don't make one reliant on something at the very top, right? You make things that if there's a failure somewhere, it goes somewhere else, so the whole thing doesn't blow up, right? So my question for Robert is, so Robert, I mean, and I actually agree with you. Like, so I go to South America a lot, and I was in Lima, Peru. And if you ever went to Lima, Peru 20 years ago, you had to hire a driver, and it cost you $15 to $30 each to go a mile. Right. And then Uber came to Lima, and it's now $2 to go from one end of town to the other. Right. And the drivers love it because it's all digital. Right. So my question about, and you talked about how DeFi is going to grow dramatically in developing countries. So a lot of these developing countries don't have access to energy. Right. They're very low. The electric grids are poor, et cetera, et cetera. I mean, there's big distribution of mobile phones. Right. But does that, in some respects, is ESG in conflict with this DeFi movement in terms of, like, for example, France won't sell coal burning technology to Nigeria, which has a huge energy deficit because it's not ESG, but then the Nigerians, they need it to be able to fuel DeFi. I mean, I don't know. There seems to be a conflict between the two. Thoughts?
Well, so I think that with layer 2 of Ethereum in the next 2 or 3 years, the adoption rate will go up and you'll see fees come down. But also there's a movement for mining of Bitcoin, which is over half the market cap of crypto, to be more using renewable energy, geothermal, solar and wind and flaring natural gas. So that's a big trend in Texas. So but I want to interrupt myself for just 30 seconds. Gudrun asked a question in the chat about tech valuations in fintech. So I would recommend to her and others to go to CB Insights and download a free tech valuations report, which is a little bit out of date. It's the third quarter last year, but it talks about deal volume being down over 20% quarter on quarter, and the valuations pre-money, post-money. So that's a good report. And so the mega trend is digital transformation in Latin America and other developing countries. There's a huge wave of tech startups in Southeast Asia, particularly Indonesia, Singapore, Malaysia, South Korea, so Taiwan. You're going to see a lot of new fintechs coming out of Asia that are going to be unicorns. And so the energy efficiency of fintech led by DeFi, I think, will increase a higher percentage of renewables, so they'll get a higher ESG rating, to answer your question.
Real good. Daniel, you wanted to talk about the whether DeFi is a good thing in general, or that's in for the fintech in general. I mean, you raised
I'm
that issue.
I'm gonna do a couple of things. One, if you know me, I love a good prop. So here comes the mic. Two, I want to take one step back, take several steps forward, and go back to a question that was asked to Jacqueline earlier, which is about the diligence process, and as it relates to finding good deals, valuation, et cetera. I mean, you guys are all sitting in San Francisco, the heart of Silicon Valley, and I think when you look at something like a case like FTX, or I heard people talking about WeWork, or if you think about Theranos, we hear about all these terrible situations that turn into documentaries. And a part of the diligence process, to me at this point, it has to come down to psychological or psychiatric evaluations, right? Because a lot of VCs tend to get really hyped up on the next big thing, and they look at these young entrepreneurs and CEOs and they call them the Messiah. And it's no wonder that if you keep calling them and treating them like the Messiah, they end up with a Messiah complex. And so the way I'm landing this plane, Arthur, to talk about decentralization, whether that's a good thing or a bad thing, is because a lot of people are now looking at FTX and they're saying, oh, centralization is a bad thing. And I would say, no, centralization is not a bad thing. Trusting a sociopath with your money is a bad thing, right? I think that's historically proven to be true, right? Investing in early stage diagnostics is not a bad thing. Trusting someone who dropped out of college and doesn't have any experience to run a multi-billion-dollar company or hundreds of millions of dollars is a bad idea. So decentralization in general, just to ask this question, and maybe this is a polarizing opinion, maybe it's not, it's all a function of centralization or decentralization of who you want to point the finger at when things go wrong, right? I'm a fan of centralization when it comes to the banking system, because even though it's not a lot of money, when I put my money in an FDIC insured bank or institution, I have some degree of comfort that worst comes to worst, I'm going to get my money back somehow. If I use a Sushi Swap or some other DeFi platform, then I don't point the finger, I point the thumb, and it's back at me. Like if I lose my cold storage, or if I get sucked up by arbitrage risk, or something bad happens, or there's some sort of hard fork in whatever blockchain that I'm using, and I go to zero, that's not somebody else's fault. That's not Sam Bankman-Fried's fault. That's not FTX's fault. That's my fault. I also think that's a bad thing, and that's where the regulators come in. And I think decentralization in general, and I'm sorry I'm using this as a dissertation, is almost like a farce, right? Because we think about decentralization and we think about smart contracts and blockchains, but we're really just relying and putting a lot of blind faith in the people that have created these distributed ledgers, right? Whichever chain that we use, whether it's Ethereum or Solana or what have you. right? And most of us know how to read English, but most of us do not know how to read Solidity or write in Solidity. So we've just taken our faith and we put it in something that we understand less, but we think is more transparent. So I think I said a lot of things, but I just wanted to raise the question whether it's actually a good thing, because I contend that it's not, and I think people are going, the pendulum's going to swing in the other direction towards decentralization because of what happened to FTX, but they're not really addressing the root problem, which goes back to the diligence point. So there's a lot of things for people to pick up on here. Maybe this is a good thing, maybe it's bad, but I'll stop talking for the time being. And there goes the prop.
Daniel, if I could jump over just a second, Robert, sorry. Bernie Madoff didn't drop out of high school, had a stellar resume, and still, this happened. So it's right. So just taking the opposite side of that argument, there's due diligence is like a massive, comprehensive process, right? That hits on all of that, just even beyond the resume. There will always be failures like that.
And actually building on what both of you just said, both Daniel and Julia, I think it goes to a little bit to this institutionalization, right? The reason that we trust banks is because they have risk departments and they have processes and they have, policies in place. And I think what we've seen in a lot of these failures in the crypto world of just like one person with too much control. And whenever you have that in your diligence process, that's the red flag.
Great. Having opportunity to ask, what happens to all those companies that FTX has invested in, let's say, and they get a part of the Series A, B, or whatever to develop their own companies? Is there a clawback on those guys, or how's that work?
Well, Skybridge is planning to buy back $40 million from FTX because that was the investment made last year. And there's a lot of companies that just don't have the resources to buy back stock. So they're stuck and without having partners to do Series B, Series C, then many will go out of business.
Okay, so but that's the part of the bankruptcy proceedings in the sense of the who will become the owner of those shares, or there's a callback immediately because of the situation of the FTX is more of my question.
That's a legal question.
That's a
okay.
good question for a bankruptcy.
A free advice.
Yeah, if only you guys were sitting in a law firm where there could theoretically be a bankruptcy lawyer sitting somewhere.
I'm not one.
I mean,
but I think what happens, generally speaking, in any bankruptcy is that they marshal the assets. They get the assets together and they protect them, and then they figure out what to do with them. So I'm not a bankruptcy lawyer either. I'm sure we have one sitting in the office somewhere. But the complaint was published, and it's actually I started reading it. It's pretty interesting.
Yeah, because that's going to be a lot of Sam was a very generous guy, right? So he invested in a lot of generous. He invested in a lot of fintech companies here in the city, and essentially now those companies, the fintech companies, are their valuations is being downgraded, right? But they're on a path of actually making some sense out of their companies, right? And if they need to pay back whatever they gotten from Sam, they're going out of business.
Well, Sam was also generous to a lot of politicians, so I'd like to see how many political campaigns actually end up giving back the money or having to give back the money. That's more interesting to me because it's less straightforward, and I imagine those people are less liquid too.
Okay. Sounds good. Like I will refer that to some other, more specialized lawyer, because that's some subject that really interests me because of knowing a lot of companies that actually Sam had invested monies into, and they, as I said, like they're on a good track to get developed, but if they need to return the money now, it is an issue. So in any event, I think that we're kind of like wrapping our.
Do you have any questions from the audience?
Yeah. Any questions here? No, not a lot of questions. I guess I I think we're just a minute or so away.
Yeah. Let's, why don't we do wrap up here?
Yeah, let's do the wrap up. Robert, you wanted to tell us what your feeling is on the upcoming year, since
Well,
we're
because
just a
of
bit.
the nature of the political deadlock in Washington, there are staffers who are making progress on legislation for tighter controls, more control of digital assets and fintech regulations. And there were a series of reports ordered by an executive order of the president last spring. And finally, those reports came out in November and December. And I think that the most important report is about the role of US central bank digital currencies. I think it'll supersede stable coins like Tezos will go away, and you'll have CBDCs dominating the stablecoin market as an intermediary currency for fintech. And so that'll be highly regulated. And by definition, there'll be cybersecurity built in, KYC, AML as a service built in. And as we see more and more embedded finance into non-financial firms, you're going to see more regulations applying to non-financial verticals like gaming that will have to have gatekeepers for fintech in the cloud, automated, to protect not only the digital infrastructure, but protect the flow of funds between banks and fintech apps embedded into gaming and embedded into non-financial systems. So.
Great, Daniel.
Yeah, I think I know enough to know what I don't know, so I'll talk about what I do know, which is the Web3 space. And I think, looking ahead and wrapping up, if you're doing anything that's on the margins, if you're doing anything that you don't, if you think is in a gray area, I think the world has fundamentally changed from a year ago, and I think the world has fundamentally changed even from 3 months ago. You're now a target, and you're a target to either come into compliance or a target for an indictment in the worst case scenario. So I think, given that the world has changed, compliance is at a premium, and I think everyone at K&L Gates and Jacqueline will appreciate that sentiment. But also, like with any other industry, and I'm speaking about Web3, and I'm speaking about blockchain specifically because that's what I do most of my work in. You always have a sequence of success, initial success, and then hype, and then a lot of other companies and people that are trying to replicate that with style more so than substance. And I think across verticals and across industries, we're having a return to substance like we always do, and good applications of blockchain technology as opposed to everything that we've seen in terms of speculation, et cetera. So if there is two things that I would trump and two things that I would think are paramount in 2023 and moving forward, it would be A, compliance, and B, substance. And that's it.
Julia?
I will conclude by summarizing, agree with everything that the esteemed panelists have said, and there is going to be really, as regulation starts rolling out, there was recently regulation passed on cybersecurity just a couple of weeks ago, and there are no new requirements for cybersecurity. And there's one quantum cyber firm, for example, in the United States that is based entirely on US soil, that's going to stand to benefit from that, as opposed to a lot of players that draw on offshore resources, as an example. So as more regulation rolls out, it's going to separate winners from losers in a lot, for a lot of these fintech firms.
Jacqueline?
Thanks. Particularly in the family, I agree with everybody who's spoken today. I think it was a really great panel, and thank you all for being here. I think particularly with respect to family offices and investments, we're going to see heightened diligence, as we've talked about, and we're also going to see moving more away from crypto and toward other applications of blockchain. I just feel like that's going to be the safer spot for family offices to land, and they're going to put a lot of their capital there.